Well, welcome back to Wedgemount Resources channel, focused on the acquisition, development, and optimization of conventional oil and gas properties. And joining to give us a high-level overview of the investor presentation today, as always, Mark, the CEO, joining us. Welcome back, sir.
Thanks for having me on. Appreciate being here.
Always a pleasure. So I'm going to hand this over to you to take the reins and walk us through this.
Yeah, I'm just going to give, we got a short deck here, just a few slides on some basic background of the company, kind of how the company was put together, what the strategy is, what we've done to date, and what we're going to do over the coming few years. So Wedgemount's an E&P company. We're focused in the Permian Basin of West Central Texas. We're on the eastern shelf of the Permian Basin in the conventional oil zone of the Permian. A lot of people think of the Permian, they think of the big shale plays in Midland, west into New Mexico. We're a little bit east of that in the conventional backbone of the Permian on the eastern side there. So just by where that is, about 3 hours southwest of Dallas-Fort Worth and about 3 hours north of San Antonio, Texas. Our operations are based 30 minutes south of the city of Abilene, which is about 200,000 people, if people have heard of Abilene previously. So what we do, our vision down here in Texas, again, we're Permian Basin. We are a consolidator of oil and gas assets. So we acquire, develop, and optimize distressed oil properties. Those can be either operationally distressed, they could be financially distressed, or ideally a combination of both of those. So we acquire producing low entry cost assets. We do innovative enhanced recovery techniques with specialty chemicals and workovers to optimize production of existing wells, and most importantly, grow cash flow and reserves with limited capital. That's the vision of the company. Why West Central Texas for Wedgemount? Well, it's the largest basin in the U.S., so there's a ton of potential target assets. As I said before, people know the Permian because of the shale plays, and that's about 2 hours west of us, Midland, over into New Mexico. That's where all the big household names are. That's where the Exxons are, the Conocos, the Marathons, the EOGs. That's where they're deploying huge budgets and a lot of people and equipment in those areas. We're just slightly east of that. So because so many people are focused on big scale stuff, big companies need big assets to move the needle rather. Private equity needs to deploy 350 million to $1 billion to move their needle. So a lot of the smaller stuff gets left behind, and that's where we are focused on smaller assets in the conventional part of the Permian. The other reason we came down here, opportunity to partner with an established turnkey operator. That's our partner, Valkyrie Specialty, and their CEO, Heidi Flagg. Just outstanding people who have not only the technical knowledge of these assets, but they have long-term relationships with landowners and operators in this part of Texas, which is absolutely key to source assets and to source assets that you technically understand the opportunities. Multitude of financially strapped operators. Again, during the downturn of the oil market between 2014 and 2020, there were so many distressed assets here. Whether they're mom and pops, small operating companies, ranchers, you name it, there's a ton of opportunity here because of the financial downturn in oil prices. I mentioned before about the large shale operators. Again, because the scale of what they're doing is so big, they've sucked out capital, people, equipment, you name it, out of the conventional Central Texas oil industry and the conventional side where we are. And luckily, we have the people, the capital, and the expertise to go after these types of assets where there's very little competition. Another reason, less competition, lack of long-term relationships and access to information. During the downturn, so many people left the industry or went bankrupt or just kind of disappeared. So having the relationships that our team does on the ground with landowners in Texas is absolutely huge here, and hence the access to information from those operators. There's a large inventory of underexploited reservoirs where modern oil field technology has not been used. Just a key point on that. And what I'm talking about are things like horizontal drilling. In the counties we operate in, basically all the wells drilled here were conventional vertical wells. There's been very little of the optimization through horizontal drilling, through fishbone wells, that type of design. So we are able on a go-forward basis to use those modern techniques in assets that have not been optimized by those. And lastly, lack of available credit and equity from traditional providers. A lot of the small operators here could raise equity. They could get lending from local credit unions. Most of that has dried up over the past few years. Our acquisition development approach, and if people want to really think about what Wedgemount is, this is a really important slide because we do this day in and day out, and we want people to hold us to these key facets of our development approach. So number one, at 12 o'clock there, you can see we acquire distressed properties. We've done 4 deals to date. We consolidate adjacent property. So everything we own is just south of Abilene, Texas. We've done 4 deals. You can drive from one end of our assets to the other in 20 minutes. So it's a nice concentrated area where we understand all the technical challenges, all the operational challenges, logistical challenges, and we can have our team come in from Abilene. Our team stays in Abilene, so we're only 30 minutes from the asset when the team is in the field. What we do is we enhance and optimize existing wells. This is not exploration. We're taking existing wells that have had a lack of capital and a lack of technical expertise, and we're applying our techniques, our expertise, our specialty chemical treatments to these wells to optimize them. And to date, the results have been outstanding. We return wells to production. About 50% of what we bought was not running at the time of acquisition. Our first 3 acquisitions, we've got all the wells up and running now. Our most recent large Huggy acquisition, we've got about half the wells up and running now, or just over half the wells up and running right now. And a lot of these are not running for really basic low-cost reasons. So there's a ton of low-hanging fruit. Lastly, the last 2 points here will target behind pipe potential. In the areas we're focusing, they're up to 6 producing hydrocarbon zones or sands above where we're currently producing some from. So over the next few years, you'll see us start to target some of those underexploited or non-exploited reservoirs where we see a ton of potential. Basically here, just like in Western Canada and other parts of the world, people drilled what was easy and what was known. And with modern technology, better equipment, better completions, better drilling, we can target some of those bypass pay zones where there's a ton of potential. Lastly, down the road, this would be more of a 2026 onwards, we can drill new wells. We have well over 100 drilling locations on our current assets, so there's a ton of running room for growth here. That well on the right is one of our wells, standard conventional vertical well, pump jack there. That's what they look like when we buy them, when we start off there. Next slide. This is Wedgemount today. This is post our most recent acquisition, which more than quadrupled the size of the company. So our producing assets, we purchased 4 operated conventional low decline assets, 3 last year and 1 this year. We're 136 producing wells, 10 injectors, Permian, as I mentioned. Neither the acquired wells nor the surface facilities have been optimized by prior operators. This is the low-hanging fruit for us. This is the reason we've been able to grow so much to date, and the reason we've been able to grow at a low cost base. Our average purchase price, me being a financial guy, I love this metric. We've been buying at around 22,000 EV enterprise value per flowing barrel. And by the way, our barrels here are about 80% light oil and 20% natural gas. So far, we've optimized wells, adding producing barrels at 2,500 EV per flowing barrel. That metric I would put up against anybody in the industry. To grow production per barrel at 2,500 gives us a blended between purchase price and organic growth around 7,500 EV per flowing barrel, which is about a fifth to where the M&A market is for light oil assets in our part of the world. So very low cost. Average production growth, we've done fully treated 19 of our wells to date. The average production growth is around 825%. Over 50% of the acquired wells, as I mentioned before, were non-producing at the time of purchase. And these are very low cost, low hanging fruit opportunities for us because simply the previous operators neither had the people nor the technology nor the capital to put these wells back on. And some of them there's fixes as low cost as $200-$300 to put a well back on it. It's incredible low hanging fruit. All the assets are in one core area. Again, this is key for economies of scale and ease of logistics and services in our area. Repeatability, what can we do in the future? There are multiple undervalued assets in the area for future growth. In fact, we have over 750 wells we've already done due diligence on, another 30,000 acres that we could buy tomorrow if we wanted to. At this point in time, we have a lot on our plate for growth with the existing assets, but the runway here is very broad and we will get to further acquisitions down the road here. So this is not a 4 deals and done company. We have a huge runway in which to grow. Our progress to date, this is on the initial 3 assets, so this is not including the most recent acquisition we acquired. You can see that in the bar graphs on the left in the blue. prior to about 35 barrels a day total production. We got that up to just sub 300 barrels a day current production. So obviously a huge amount of growth. I think I mentioned before, 825% growth per treated wells. So very systematic approach. These are producing wells or shut-in wells. We go in and we re-enter previously inactive and underperforming wells. We do workovers and specialty chemical treatments. You must chemically treat these wells to address things like asphaltene, paraffin, scale, and corrosion, which inhibit not only the productivity of the wells, but also the recovery of the reserves from the reservoirs. That is absolutely key, and we wouldn't be doing this without the specialty chemical expertise. So that's what we've done to date. Here's an example of value creation. And again, being a finance guy, I get excited about this. This is an example of what we have done and the low-cost manner in which we've grown production. This is our Davis lease. This consists of 2 wells here. Now, the reason I'm using these 2 as an example, they are 2 of our best wells. I will say that right out loud. But the reason I wanted to use these 2 wells is because they've been on the longest. These have been on over a year since we started doing our work down in this part of, on this particular lease. The acquired production on the 2 wells was just over 3 barrels a day, and they were doing combined about 20 barrels a day of water. We've now got that in our most recent release. The Davis wells are doing 45 barrels a day, BOE per day, again, 80% oil and 20% gas, and just about a barrel a day of water. So how did we do that? We use workovers and chemical treatments. Total cost, $78,000. Production growth of 42 BOEs a day. So you can see the payback period, very short. That's assuming $35 operating netbacks and the cost per flowing barrel at $18.57. Again, we would put that up against any other producer in North America to do it for that low of a cost. These are vertical wells about 4,000 feet in depth. And again, workovers and chemical treatments. Not all our wells will be this good, but this is an indication of what we can do. And if you take the average overall, we're a fraction of where the peer group is trading and where the M&A market is trading on a cost per flowing barrel. The Huggy asset purchase overview. This is the deal we completed in August, and we financed recently with our convertible offering. I touched on some of it before. So this is light oil and natural gas. Got a ton of growth potential. This is a complete game changer for our company. So low cost, low decline, under optimized wells. Again, this year producing wells with all facilities. This is not exploration. This is not even developing 2P. These are proven reserves here, proven developed producing and proven developed non-producing wells that we're optimizing here. 2 core fields right in our core area, similar geology, similar operations to what we've been doing to date. We bought 111 vertical wells and 8 injectors. Injectors are key here to dispose of water and to which helps keeps your costs down. Also, those 8 injection wells, it's really important. These assets are perfect for a long-term water flood on secondary recovery, and the injection wells are operating as a pilot for that currently. Got 20,000 acres, 100 drilling locations. Current production for the assets around 72 BOEs a day, multiple bypass zones. And again, we've got local labor, we've got infrastructure that's mature that we understand how to work it, how to optimize it. The last bullet there you can ignore because we have closed it. The financial metrics of this deal were, I congratulate our team on negotiating this. So we have 100% working interest, 75% net royalty interest. Again, this is private land. Pretty much all of Texas, Oklahoma, Louisiana is private land. So you got to pay a royalty to the holders here, but 25% is industry standard. Doesn't matter if you're Exxon or Wedgemount. That's what you pay to the landowners. We paid $840,000, which is $12,000 a flowing barrel, which again is less than a third of where the M&A market and traded comps trade down here. So that was an outstanding purchase price. We think we'll do about 3.6 in net operating cash flow from the asset next year, which would be 1/3 of what we paid, a 1/3 cash flow multiple, which again is an incredibly cheap acquisition. The proven developed producing, this is from former management there. So I put that, I want to highlight that. That number is going to change when we do our reserves. The first reserve report for these assets will be early in the new year, and I would expect significant upside from that number. So a growth strategy, we enhance the assets, bring on shut wells, chemically treat the wells. This asset alone, we're targeting around 900 BOEs a day in the next 12 months. Total production about 900 BOEs a day. this time next year, and declines 5 to 7%. It will be decline post well optimizations. This is what the company looks a year out. These are our estimates at this time. The map on the left shows you exactly in Texas where we're located. So that carve out is the Permian Basin, where you can see we're on the eastern edge, known as the Eastern Shelf of the Permian. So forecast 12-month production, Wedgie, and I just say Wedgie, that's the existing assets prior to the deal, 400 barrels a day. We're pretty close to that already. The Huggy acquisition, we think, again, we can add another 900 by year and next year. So corporate total, we should be around 1,300 BOEs a day, give or take. Proven developed producing, PV10. This is, again, I put an asterisk here because we will get new reserves out, and I really want people to look for those. We'll obviously be press releasing those. We think there's a ton of upside in the reserves here because of the work that we do. 12-month net operating cash flow. People can put their own oil price sensitivity. We're running $75 here. I know WTI is a little lower than that. We generally get a slight premium to WTI, 7.4, which is pretty much our enterprise value right now. So attractive valuation on Wedgie as it stands right now as a complete company. Evolution of Wedgie post-acquisition. This is what we look like. Just going through the boxes there. So big acreage position, 25,000 acres. Again, we got 136 producers, 10 injectors. Of the 136, currently just over half are producing. We'll slowly bring those on over the coming months and then optimize them over the coming months. Drilling inventory, it's well over 100. In fact, the number's closer to 400 under allowed spacing from Texas Railroad Commission regulations for our core area. Forecast 24-month production, I think we can be over 2,000 barrels a day, and that's just with existing wells. That's not including any new drilling. So any new drilling we do would be on the upside. Again, the reserves, I think everyone's going to see that. We'll have our third-party engineered reserves out for just the initial 3 assets that'll be coming out in the next few weeks. And then for the new acquisition as well with the historic assets, that'll be early Q1 2025. You can see some multiples. Operating cash flow acquisition multiple was ridiculously low. Pro forma year 1 EV to BOE per day. That'll obviously change depending on our share price. Marketing and transportation. We've got a new marketing and transportation partner, which should help our margins. You can see our decline rate and uphole bypass pay potential. This is something that's absolutely key. I touched on it a little bit earlier. There's up to 6 zones here above where we're currently producing that we can use for future development. And we'll get to those. That's going to be a late 2025 or 2026 focus of the company for additional growth. Bypass pay potential. This is one example. For those of you who are a bit more technical, this is one sand only of these bypass pay zones. This is stemming from our first acquisition where we have part of the Cree Sykes field. We've got 1,100 acre position there of a play we call the Crosscut. This is a sandstone that's 36 million barrels in place. You can see our calculations are based on the right porosity, permeability, and the size and thickness. Technical people can get into that or just call us for a bit more detail on it. 36 million barrels in place, 70 feet of net zone developed, additional zones around the main target. And there was a couple of wells drilled in this many years ago. One of them did over 100 BOEs a day. These wells were shut in after a year because they were not treated for paraffin and asphaltenes, which is something that we understand very well that you have to do to be successful in this area. So we'll go back and target the crosscut sand as one of the potential zones here. But again, if you assume primary recovery on 36 million barrels, 15% or so you're looking at over 4 million barrels of light oil, which would just be absolutely huge for a company the size of Wedgie. And again, this is just one new zone. It's been drilled through before. These are proven undeveloped reserves here. So we will get to this. And again, this is just an example of one other growth area on top of what I've talked about in the existing wells. Our partner, people can browse this at their own time, Texas-based Valkyrie Specialty. All the chemical expertise and workover expertise and what we do here is Valkyrie Specialty that helps us with this. Their CEO, Heidi Flagg, is our head of operations, and you can see one of the wells on the right there. That's what paraffin looks like on a polish rod, on a pump jack. And you can think of that going all the way down the well, clogging up the well, prohibiting the oil from flowing, prohibiting us from developing, or previous operators from developing the reserves of that. So they do everything from us, from workovers to chemical treatments to dealing with the leaseholders, et cetera. And it's just an outstanding member of our team down here that we owe a lot of our success to. Capital structure, pretty self-explanatory. 52 million shares outstanding. We got 22 million warrants. 100% of those warrants are at 30 cents Canadian. Those warrants start expiring in December of 2024. You'll have approximately 14 million, which will expire by the end of Q2 of 2025. The balance of the warrants, 7.9, were part of our recent convertible debenture offering. Those have 3 years left on their term, or just under 3 years now. And they're also at 30 cents. Share price, you can kind of see our market cap, enterprise value, etc. We have a bit of debt on the balance sheet. We've got term debt of $680,000 US. We got a VTB, vendor take back, for our third acquisition we made, the TCS assets, and the unsecured debentures are recent financing there. So that's the capital structure, completely up to date there. So that's Wedgemount in a nutshell. But if I can leave you with one thought about this company. I've been working in the oil and gas business for 25 years. The reason we undertook these assets with this team in this location is I saw it as the best risk reward I've seen in the industry in 25 years. Everything we're targeting here is proven developed or proven undeveloped. So there's very little geological risk here. It's really for up to us to execute on the operation side. And I think to date we've done a great job, and there's a ton of growth in front of us here.